Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So, before we get started, I just want to point this out. I don't know if you ever heard of this book called If I Did It, Confessions by O.J. Simpson. But basically, it's a book where O.J. Simpson is basically, well, if I committed this crime, this would be my confession. And it's kind of related to this video because it's like, well, if I were a cult leader, a velocity banking cult leader, this is what I would instruct people to do. Doesn't mean I am, but for some reason, let me actually reload this. When I posted this, click here to join the velocity banking cult, a lot of people wanted to click it. I have no idea why. A lot of people wanted to click it. And actually, let me go to the comments here. If I type in cult, you know, well, obviously there was this one from yesterday where, if they would only listen and join the velocity banking cult. Love the enthusiasm. And actually, let me go back here and then look for other ones. Let me scroll down. Well, at least you admit it's a cult. Hey, hey, hey. I were a cult leader, I'm not admitting it. I'm kind of like OJ Simpson. If I did do it, right? These are my confessions. Let me scroll down here. Cult leader, thank you. You're building a cult. So I don't know. What do you think? Do you think that there's a demand for a velocity banking cult? I feel like there might be because I've seen these comments in this video, or not in the video, in this channel, where people are saying, you know what, all these years of conditioning, and I feel so strange putting all my money into a line of credit, right? I remember comments like that. And, if I were a cult leader, again, like AKA like OJ Simpson, if I did do it, if I were a cult leader, I would tell you every morning, wake up, and tell yourself your line of credit is your main operating account, not your checking account. Only I don't know what's a nicer word than heathens. I'm trying to think of it right now, but I can't. But only um, the non-financially free use their checking account as their main operating account when they're paying off debt. But us velocity bankers, we use our line of credit as our main operating account. That's what you got to do when you wake up every single day. So now let's get to it. Let's go ahead and review velocity banking for today. So, what is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account, right? So, there's only two requirements for this. Number one is a budget, and number two is a line of credit. And you might be asking, what's a line of credit? It's this really cool thing that banks and credit unions have where you just go to their website and you click a button, and then money comes out to your checking account and they let you borrow it at a certain interest rate, right? So usually it's at like minimum 10% probably, 10 to 15. I think by law it's like the max is like 18, I think. But yeah, you just go to a bank's website and actually let me show you this right here in real life what a line of credit would look like. So you go to the bank's website. Oh, you got $15,000 available. You just click a button, and then bam, you could pull money up to $15,000 into your bank account, and then charge an interest rate. And I know some people might freak out about this 15% interest rate. And well, why would I do that when I could take a loan at a 3 or 5 or 6% interest rate? Because when it comes to loans, they're one-way streets, and there's no incentive for us to overpay them. This is why people always keep savings in an emergency fund. And if you ever look at people like Dave Ramsey, they say, hey, first thing you want to do to pay off debt, just save $1,000. Whereas what we're doing, we're going to make sure that the savings that we always have is zero every time the statement balance comes, because we're applying all of our money into debt, right? So let's go ahead and just kind of make up, I don't know, a line of credit. Let's say we have a $50,000 balance, and let me actually erase all of this. And actually, let me start from the beginning. So yeah, so some people, I just got a comment like, well, what do you do if your line of credit has a balance on it? Well, you still make it your main operating account. There's absolutely no difference, right? People don't, I don't want to say think, but it's like you have to give them every single step, and this is what I notice happens, and then they act like, well, what do you do? And here's the thing, I used to be a school teacher, right? And I remember once upon a time, I actually gave all the answers and explanations to tests to the kids right before like the test day happened. And then I emailed everybody. I was like, here's all the answers and the explanations to the test. and almost everybody failed. That's where we're at as a society. So when people say like, "Hey, like, what do I do?" Like, I just literally say the same thing every single time, and people think that because they're exceptional, that somehow their case is going to be different. When 9 times out of 10, it's not going to be, right? But again, people get really offended by that, and then you become a target, and they're like, "Oh my goodness, hate smear campaign," and next thing you know, people are branding this as a cult, and that's saying if this were a cult, right? Like, I'm not saying it is, but if it were a cult, I'd be saying like put your checking account as not as your main operating account, but your line of credit. Anyways, so let's go ahead and get started. So let's just assume that we have a $50,000 line of credit available to us. 9%. Usually you only get 9% if you're like doing a home equity line of credit. I'm currently getting a new home equity line of credit, and they said 8.5. I'm like, woohoo. So I just got to sign the dotted line and I'll be good to go. So that's all right. So now we're just going to do this. So yeah, first things first, we need a budget. And as you can see, I did the budget for the average American. And so, what is the difference between the average American and the Velocity Banker? Well, we assume it's the same income, right? And the expenses are going to be the same, okay? We're going to say we're starting off with the same expenses, but look at this big fat zero in our savings. And this is the part where people get totally uncomfortable. The big fat zero in our savings. And what we're going to do is once we make our line of credit as our main operating account, well, we just dump our entire pay into the line of credit expenses out. Now, if we have a balance in our line of credit, and I've actually shown this scenario in our paid live stream, 99 cents per month, if you want to join the YouTube channel. And then, don't complain that I just do the most basic scenarios and put the more complicated stuff behind a paywall because, again, why do I do that? It's not because I need your money, because you pay attention, right? And the more you pay, the more you pay attention. And people don't understand this, right? And I noticed, like, I'm very observant of my own behavior. Like, if I downloaded a movie, and I'm not saying I actually do this because, again, I'm like OJ Simpson if I did do it. If I did download movies on my computer, I wouldn't watch them because, if I had unlimited access to free movies to download them, I don't take it as seriously as much as if I actually go to the theater and pay like 15 to 20 bucks. Because, it's a bigger, not only is it just a bigger investment in money, but it's also a bigger emotional investment. So if you're saying, "Hey, I can't even pay the 99 cents," like, what makes you think I'm actually going to take this seriously? And what makes you think I'm going to take you seriously? Right? 99 cents. Now, obviously, I got higher tier options. I got like a 2 grand option, and I got a 20 grand option. But, like I said, if you don't pay, you don't pay attention. Right? All right. So now let's get to this. And let's go ahead and move some of this debt into the line of credit. And the first things that we move is the credit cards, the easiest debt to move, right? So this is 16 plus 16, so I think there'll be 32K. So let's move 32,000 and wablam. So we were at a whopping $1,000 a month, which is amazing for the average American because your average American doesn't have $400 a month to save, right? And then what we do is put that zero, the big fat zeros in the credit cards, and we went from $1,000 to $2,000 a month in cash flow. And so what we do here is now we put that entire 5,700 into the line of credit, which does two things. It satisfies the minimum monthly payment, and then it also minimizes the interest because the interest is calculated on the average daily balance. So when you put that entire 5,700, you're not going to pay as much interest, right? So let's go ahead and do the calculations. So these calculations are easy. Next month's balance is based on the previous month's balance plus the previous month's interest. Whoopsie. H2 minus, not H2O, I think that was a Halloween movie, minus our cash flow right here, which is 2081.9. All right. And then what we do is we calculate that average daily balance. Let me go ahead and do that. Calculate that average daily balance here. I get this thing called the average function, and then I just take this as an estimate of the average and then multiply it by 0.09 because it's 9%, and then divide by 12 because that's the number of times the statement balance comes out, and that's when the interest is calculated. So we're going to do that, and then we can see in the first month we only paid $232 of interest, right? Wablam. Okay, and then now let's go ahead and do this. See, it takes us about 17 months to pay off this debt. Woohoo, 32 grand, right? So now it's 32K, and then it took us 17 months. I mean, just check. Yeah, 17 months to pay off these credit cards. 17 months, okay? All right. So now what we got to do is we have a student loan, an auto loan, and a mortgage. Okay, and now what do we focus on? Well, I'm going to tell you this, it's pretty much the auto loan. Not only does it have the highest interest rate and the lowest balance, well, it doesn't have the highest payment, but the thing that we have to take into account is the amount of cash flow it takes. So think about this. Like, let's compare these two loans. If I'm paying this auto loan off first, I get $430 of cash flow back. 22,000. But if I pay the student loan first, 45,000, I only get $477 back. What's up with that, right? So we don't want to just kind of look at the interest rate, which is what most people do. And I could show you my home equity line of credit where I actually pay 10%, but if you summed up the total amount of interest that I paid, it's actually 0.09 or something like that, or 0.9. So not even like 1% of interest, even though it's a 10% APR, because I know the strategy. And again, results not typical, but I've shown it many, many times before. And then people just always talk about their theoreticals, and I'm actually showing you results. In fact, I paid off my mortgage under 3 years, right? But results not typical. But you can do your armchair theorism, but you'll find plenty of people on this channel tell me that they did it, and it's like, okay, well, why don't you go back in time and tell them not to do it, right? Okay, so let's go back here, and then we have this loan calculator here that if you have the original balance, the interest rate, and the term, it will auto spit out the payment amount, right? These payment amounts are determined by these three factors. So if you look at this Excel function, you put in PMT, actually negative PMT, because one of them has to be negative, because technically, like, the the calculator thinks it's an annuity, so it's expecting one of the figures to be negative. But if you don't know what that means, then forget about what I said. So we have this payment function, and then not only that, we can determine the current balances of these loans. So what was it, 17 months? So if we do, hey, it's month 17, what's the balance of these loans? And one of the things you'll see is that you'll see how much interest you paid, and you'll also figure out what we call the cash flow index. Look it up on Google. All it is statement balance divided by the monthly payment, and the lower the number, that's the one you want to pay off first. Because if we pay off the 16 grand, guess what? We get $430 back in cash flow. If we focus our efforts on this or on the mortgage, it'll take us so long, so much effort to get back that cash flow, right? So let's go ahead and get this cash flow back. So 16 grand. And just as a quick summary, anything under 50 is worth paying off, and we're going to go ahead and do that. And actually, I actually kind of don't like 50 because it's not at that point of the loan. Sometimes moving the entire thing into the line of credit, you might have to pay a couple hundred more bucks instead of if you just did what we call chunking or incremental payoff. But let me go ahead and add this 16 grand, 16472.45 into the loan. And just by doing that, guess what? We get $477 back in cash flow. All right, so 2559.19, that's our cash flow. And then let me go back here, and let me go back, and now what we got to do is modify this cash flow number. So from, instead of 2081, we put 2559.19, right? And then now let's go ahead and do this. And look at the interest, 40 bucks. That's kind of really low. All right. So now let's go ahead and do this, and then now at 24 months, we paid off that car loan. So let's go ahead and mark that as a milestone. And so, right. So let me just kind of, well, it's actually right here, the auto loan. So 32 plus 22 equals 54K, and then 24 months, I think, right? Let me just check one more time because I tend to lose my spot. Yeah, 24 months, okay? All right, so now let's go ahead and do this. And so now at 24 months, we got to figure out what the balance of the student loan and the mortgage is, right? So let's go ahead and do that. So 24 and then 24. And one of the cool things about this is you can kind of sum up all the interest. So you obviously paid about $1,700, right? And then if you sum up the entire amount that the line of credit was used for that interest, and you could kind of somewhat estimate like what the interest cost is for using that line of credit and how much interest you paid, because that's the thing that really matters, right? Like you don't want to get in a situation, and it is actually possible to get into the situation where you paid off the loan quickly and then you ended up paying more in interest. And the only time that I've really seen that work that way is with a 30-year mortgage. A 30-year mortgage. Like you move an entire 30-year mortgage from like, let's say a 3% into a like a 9 or 15% line of credit, you'll end up paying up more than had you just kind of did the 30-year payment, right? Like you don't want to do that. And I talk about that all the time. Anyway, so let's go ahead and as you can see right here, that cash flow index is above 50. So the most optimal way to get rid of this is not to put the thing into line of credit, but just to kind of do it in incremental pieces. So what I mean by that is let's just do this. So let's move $6,000. You know, you could just do a small number, rule of thumb, similar to your paycheck, into the line of credit, and then just repeatedly, like kind of like chopping up a mortgage, right? Like not replacing the entire thing, especially if that cash flow index is really high, but chopping it up. Um, into incremental pieces and then doing it over and over again. So for example, let's say I take out 6,000, then the balance is 31,000, and then I just add in 6,000 right here, okay? And then how long is it going to take me to pay off that 6,000? Like 2 months, right? So that's kind of like the idea of chopping up your mortgage. Now, if you want to put in a bigger chunk, you certainly can, but just realize, I mean, just from common sense, the bigger the chunk, the more interest you pay, right? So even though like you're making the monthly payment, and you can actually see this with the mortgage, like if you put a bigger chunk in the mortgage, the more you pay. But with smaller loans, it's not that big of a deal, right? So let me go ahead and open up this Velocity banking calculator that I always like to showcase. And let me go ahead and open it up. So, all right. Let me switch screens right here. Velocity banking calculator. And if you don't know what this is a Velocity banking calculator from Renatus. People are like, can I get this? And I say, well, if you pay for Renatus education, you can. And that scares people away because people don't want to pay for anything. You know what I'm saying? But again, if you don't pay, you don't pay attention, right? So just full disclosure, I actually sell Renatus products, education products, and this whole YouTube channel. Not only is it a cult recruitment tool, or if I were a cult leader, it would be a cult recruitment tool. But it's also a sales funnel for Renatus educational products. So if you're interested not only learning about Velocity Banking, but other things like real estate investing, financial literacy, go ahead and click the Google form link below. But it's going to cost you money, right? So yeah, it comes quote free, but only if you pay. And if you pay attention. Okay. Well, let me say this: the more you pay, the more you pay attention. Okay, so let me go ahead and put in the deets of the loan. So this is going to be a 10-year loan. And let me go ahead and actually let me just fill in the income first. So income, expenses, this is the easiest. Let me look at the other screen. Um, let me go back. So it's 5,700 in income. And then all your expenses is everything except for the loan you're trying to pay off, right? So we're trying to pay off. Whoopsie, I actually screwed up. Oh my goodness. Let me go back here. I screwed up. Okay, so it should have been 0 here instead of here. Wait a minute. I screwed up. How did I go from 0 and then put it here? Let me try it one more time. The cult leader shall redeem his mistakes. So let me say that. Okay, so let me go ahead and it says 2512, right? And let me just redo this. I don't think it's going to make that big of a difference, but I still want to be somewhat accurate, right? So 2512. Oopsie. Yeah, it's not going to make that big of a difference, but still, let's be a little bit accurate, or as much as accurate as possible. 2512.36. Okay, and then let's see this, right? and it still, right, it still takes us 24 months to pay it off. So that's why it's not going to make that big a difference, even though I did screw up. But I still want to be accurate, so let's go ahead and do this. And so now we see that the student loan is the payment, the expenses when we enter in our velocity banking calculator is actually these two numbers, right? So let's go ahead and sum up these two numbers, and then let me sum up those numbers. Where's that function? Aha. Okay. So now we put in 27, 10, 35. So let's go to the other screen, and then let's do this. 27, 10, 35. 27, 10, 35. Okay. And the chunk amount, like I said, like people make such a big emphasis on this, but it's just a small amount that's kind of similar to your paycheck should be enough. But just realize that the more you chunk, the more you're going to pay because, again, you're moving um, this 3% interest into a 9% line of credit. So, all right, so now let's go ahead and put in the original balance of this, which is, it was 45,000. Okay, and we had a 5%. And then what is our current balance? It is 37,701.25. So 37,701.25, right? And what is the payment amount? It is 477.29. 477.29. All right, so as you can see, it takes us about 1.1 years to pay off. Whoa, that's really quick. Whoa, I'm blown away. So 1.1 years to pay off a student loan. And all right, well, goodbye student loan, right? So let's go ahead into the other screen and let's just do that. 1.1 years. And let me type that in. So now this is going to be 0, right? And then, so 20, actually 1.1 times 12 plus 24. And then 37.2 months, all right? So now it's 54 plus 45. I think it's 99K. So no, hold on. 99K and 37.2 months. All right, so 99K and 37.2 months. Sweet. Oh, okay. So next one is the mortgage, right? So after, we'll say 38 months, right? So 38 months, what's the balance of that mortgage? Whoa, it's still, look at this huge cash flow index, 208. So here's the other thing too that we have to understand about the cash flow index. Even though the payment amount is low, we should still pay it off because some people might make the argument, well, the payment's so low, let's just not pay this off. But here's the thing: if this goes to full term, 360, right, 360 months, look at this. We pay 50% interest on a 3.5% loan, right? Isn't that insane? So I know some people might say, well, I can do this and all this and on the market. Listen, I don't know about you, but I'm not a stock market genius. Um, so I'll just prefer to pay off debt first before I take on risk with investments in the market, whether it's real estate or stocks. I don't do any stocks at all just because I don't understand it, but I know with the real estate, as long as you find a distressed seller who's willing to trade equity for a peace of mind, you could build wealth immediately, right? So, okay. So now we just got to fill in the numbers right here. So let's go ahead and do that. And let me go ahead and switch to that velocity banking calculator sheet. And so what I got to do is 2250, whoopsie, 225000, and then the current balance is 210792.05, 210792.05 at 3.5%, 30 years, and what is the payment amount? 101035, 1010.35. Okay, and then now our expenses have been reduced because we paid off that student loan. And now it's just going to be $1,700. All right. So $1,700. Okay. All right. And so how long does it take us? 4.8 years. Isn't that amazing? 4.8 years. And look at, so in the course of the loan, we're going to pay like 50% interest. but we reduced so much of it. Now, here's the pitfall, and here's the thing you have to be careful about and not listen to all the advice on the internet and do your calculations. You might hear, oh my goodness, let's go ahead and replace this mortgage with the first lien line of credit. Okay? And guess what happens when we do that? Bam, the amount of interest that we pay is kind of like more than doubled, right? Yeah, we save interest, but why leave money on the table? We don't need to do that, time and money. So again, just do it in little chunk pieces, chop it up, and you'll be good. And plus, if you need that line of credit for additional expenses, you have it available, but there's really no benefit in transferring a low percent mortgage and completely replacing with the line of credit. There's a reason why the mortgage is actually the least important debt to pay off because of that cash flow index being so high, meaning it takes up such little payment compared to the amount that you borrowed, right? All right. Well, so let's go ahead and go back to that whatever it is. So so this is 0, and then now it's 37.2 times 12 plus 4 point, was it 4.8? 4 point, where's my other screen? Yeah, 4.8. Okay, so how many years did it take us to pay off everything? Well, I screwed up there. It should be divided by 12. All right, divide by 12. And so 7.9 years to be debt free. Oh my goodness. And I think that's $324,000 of debt if I did my calculations correctly. And sometimes some of you, the viewers, actually point out my mistakes, and I'm like, oh, wow, this is okay. So you're probably paying more attention than I am because sometimes I do this when I'm really sleepy. And yeah, well, that's it for today. I mean, look at that. Went from completely debt free in about 7.9 years, including the mortgage, right? So we could actually say it actually, if we only had the mortgage, we could have probably paid it off under 5 years, right? So, but all this other debt was hampering us, and then once we paid off that debt, then we attacked the mortgage last. Okay. All right. Well, this is a Korean Atlanta mentorship. Okay, and if this were a cult, and I'm not saying that it is, but again, O.J. Simpson fashion, if this were a cult, I tell you, wake up every single day and tell yourself that your line of credit is your main operating account, not your checking account, right? Because I know some of you are conditioned to do the opposite, and I want you to succeed, right? I want you to succeed, be debt free, and be like, oh my goodness, like I can't believe I'm at the top. But which I am because I paid off a mortgage in 3 years. All right, well that's it, everybody. Have a good night, and we'll speak next time.